Welcome back, traders and investors. We have JC Parets on of All Star Charts, ready to give his take on the market. JC, how you doing today?
I'm doing very well. How are you?
Good, good. We just had a great interview with Fari Hamza, and we're ready for a great interview from you with talking about the markets. And Dennis and I don't know if you caught us at 8 o'clock. We went on a little fundamental rant, and just talking about the whole interest rate environment and and Janet Yellen is telling us that interest rates are going up, and yet the market's not cratering. So just looking at everything from the year perspective, your big winners and your big losers this year, what asset classes you think people are going to be dumping, and where do you think there may be some buying?
Well, I mean, think about it. We're almost done with the first quarter already, and the stock market is flat for the year, and commodities have been ripping all year, and treasuries are up with interest rates down. So I think that we should expect more of that. For a lot of reasons, and we look at a lot of cycles, and we do a lot of like macro work in terms of, we look at the presidential cycle, we look at the decennial cycle, we look at long-term secular trends going back 100 years, and all of these cycles kind of agree that 2014 for the U.S. stock market shouldn't be a great year. It doesn't necessarily have to crash. We could do nothing like we did a few years ago. But cyclically, this should be a slow year, so I don't think this should be a surprise at all.
So you're looking for more of a consolidation, defined trading ranges here with the all-time high and perhaps a support point, or a little bit more volatility than that?
Yeah, I mean, we should expect volatility. I figured the S&Ps were a fade coming into the year, and we haven't done anything. We've essentially been flat. We're probably going to head lower. I like bonds. I think rates keep dropping. I mean, ever since the Federal Reserve stopped trying so hard to keep rates down, rates have done nothing but go down. So I think that that's something that we can't ignore. And sentiment-wise, bonds are still hated. And we came into the year very, very bullish bonds, and so far so good. And I think that dips can continue to be bought. I mean, from a tactical perspective, if you're looking at TLTs, for example, which I know a lot of market participants use that for treasuries, I think you could stay long TLTs above 105.5. I think that's the spot.
Yep.
You get a nice re-entry if you missed, the initial move from the beginning of the year in treasury bonds. You had a nice entry point last week, and we're talking about it on the stream, Stock Twits and Twitter. TLT's a buy right here. We rallied nicely, but I still think you could keep your stop losses above those levels, and it looks to me like treasuries are going a lot higher.
What you're saying kind of fills a void that Dennis and I had in our discussion today, because we were talking about, well, if everyone's worried about interest rates going up, and there's going to be a significant move, and that possibly inflation pressures, then what the hell's happening to gold? Then gold should rally, correct? And it's almost as if the gold market doesn't believe that interest rates are going up here, and they're pounding gold. So would that fit in your thesis at all?
I wouldn't necessarily say they're pounding gold. I mean, gold sold off in the last 4 days, but gold has been the best asset on planet Earth since the beginning of the year, precious metals as a group. So just because we declined for the last 3 or 4 days, I don't think you could dismiss the entire asset class just because of a correction over the last few days. Now, with that said, I think gold structurally is still a mess. You're going to get your rallies and you're going to get your sell-offs, and between you, me, and the wall, we probably still have some more downside in this correction. If I had to guess, I would just stay away from it. It's sloppy. We had a nice move initially. Now we kind of just want to let it consolidate. In terms of, making investment decisions for bonds based on inflation and what gold is doing, in my opinion, I think you're trying to get too cute. I think I think maybe we should try to keep it a little bit more simple and not necessarily try to overthink things. And I think that the best game plan in general, but I think more specifically this year with what we're seeing, I think that the move is to trade what you see. It's not, so Treasury are doing this, so this currency should be doing that, and gold should be doing this, and since it doesn't match up, I don't know what to do.
Yeah.
I think we should just trade what we're seeing.
Yeah,
I
you
think
end up
that's
you
probably
end
our
up
best move.
you end up with analysis paralysis. Another thing that we mentioned is silver's just been a dog, and that just did not participate in the rally at all, and just kind of going nowhere. So do you trade the silver market?
Yeah, I mean, I wouldn't necessarily say silver didn't go anywhere. I mean, we did get a 12, 13% move, something like that, with the S&P 500 flat, and then we corrected. To your point, silver did underperform and kind of has been underperforming, which for the precious metal space, if you really think that these guys are going to rally, you kind of want to see silver outperforming gold, right? You really want to
Yep.
see the higher beta, sort of more volatile of the two metals outperforming to the downside, to the upside, and we didn't see that. So to your point, that is, maybe another reason why I would suggest kind of just staying away and, being more of a spectator than a participant in that space.
Going
At
back
least for
to
me.
going back to your whole asset class and the shift of asset discussion, the momos are starting to lose a little bit of momentum, and we noticed over the last couple weeks that something like Berkshire Hathaway, which represents all the value stocks and everything. I mean, this thing has just broke out and exploded to the upside. You think that this is more of a trend to come for this year? If you're kind of going to have a quiet market, that people are going to be shifting out of the Momo stocks and into the more conservative, maybe higher yielding dividend stocks?
So far, that's what we're seeing. I mean, look at, utilities, healthcare. I mean, these are, some of the strongest sectors that we're seeing so far this year. And a lot of that has to do with, in my opinion, rates. The fact that rates have been coming down. You got people who need yield, and they're flowing money at a faster rate into higher yielding securities. So that's one thing. In terms of the Berkshire, I don't know that this particular rally is so much because people are coming into the safe haven. That might be the reason. I don't know. Between you and me, I don't know how safe Berkshire Hathaway is. I mean, it trades for the most part with the S&P 500. When in 2008, when the market crashed, Berkshire did even worse than the S&P. So I wouldn't necessarily call it a safe haven per se, but I will say this: the consolidation that we saw in Berkshire in the second half of last year and the breakout that we just saw is very, very impressive on
Okay.
its own right. Why it did it, I have no idea. I don't really care. But that, I mean, when you see a big 6-month, 7-month base like that and you get a breakout, I mean, that's powerful stuff.
Are you looking? I mean, you looking at things. I know you love the charts, all about charts and trends, and with your blog and stuff. But you got to look at. Do you look at the fundamentals as well? Veconomics is pointing out here that credit in China is signaling trouble. Do you look at things on a global macro basis like that, or is that just too
I
much?
definitely look at things on a global macro basis. I don't really worry about the economy. Economic data is very backward looking, so I really don't have any interest in that. Plus, it gets revised like 18 times, so what are we going to do with that? As far as the fundamentals are concerned, I'm in the camp that all of this fundamental information and conversations that people have about, what a company's doing and their growth rate and all that stuff, the fact that we're talking about it, it's already priced into the market. These aren't secrets. So I just worry about the market behavior and, how things are moving. In terms of China, I can't speak in behalf of the economy. Quite frankly, I can't even trust what they're saying anyway, so it's another reason why I ignore that stuff. But just yesterday, we hit 8.5-year lows in China relative to the S&P 500, 8.5-year lows. So when I look at, the global macro environment and I see, okay, so equities is the worst asset class in the world this year. We came into the year bearish. It's not necessarily a place that I want to be, trying to get long on dips or something like that. I'd rather be fading strength. Within the equity space, China is one of the worst in the world, right? So after peaking in 2011, emerging markets rolled over, and now they're essentially at fresh lows since those 2011 highs. We're seeing levels in these emerging markets that we haven't seen since summer of 2009. Meanwhile, you have the United States and Europe making multi-year highs. So if you want to be short equities, I think that emerging markets, the underperformance that we're seeing there, we can continue to fade that strength. I mean, new lows, Russia, and people blame this Ukraine stuff and what we're seeing in Russia and the economic data. Russia's been underperforming for almost a decade, and we're hitting 5-year lows in Russia, and I promise you, it has nothing to do with these guys
What's going
invading
on?
Ukraine and all this other nonsense. We've been seeing this well before Putin, woke up on the wrong side of the bed or whatever.
Right. All right. Well, let's talk. Let's talk. Strategy. Just going back, to yesterday. Are you kind of like during a Fed meeting, Fed announcement, something like that? Are you kind of like, do you have your positions? Are you kind of hands off on the keyboard? Are you looking to react to what happens to cover a position? How do you approach situations like that?
Yeah, well, I don't try to make, huge bets and try to guess, what the Fed's going to do or not do or say or not say or whatever it is. I mean, that doesn't make any sense to me. But, when we're in asset classes and different stocks, we have our levels, whether there's a Fed meeting or not.
Good. Okay.
And we honor our levels, and if we get stopped out, we get stopped out. That's part of the game. It's part of the deal. It's what we signed up for, in this marketplace being wrong all the time. The idea is to limit that risk as best you can, and that's really the holy grail, is really managing risk accordingly. So on a day like yesterday, once you get the initial, knee-jerk reactions and you bounce around, and we got plenty of that yesterday, normally I like to see as the time zones start opening up, right? You got Asia opening up, and then Europe opening up, and then us finally. By the time we reopen up the next day, in this case this morning, all of the global marketplace has really had an opportunity to digest all of that. So the whipsawing around is essentially over, in my opinion, and the end result is that S&P futures are down. So that's interesting. All the emerging markets are down. Treasuries are flat. I think that something very interesting that we should be watching, and you talk about yesterday, is the euro. So if you look at a longer-term chart of the euro, we've been making higher lows since the peak in 2008. And if you draw a trend line straight from the peak in 2008, we ran right into that over the last week, and we failed miserably yesterday, and we're selling off. And, the market has memory here, and there's overhead supply, and I think that the euro is probably still a fade. You could use Euro USD, you can use 139, let's call it 66, which is the highs from the 13th of March. You could use that as your stop. We take that out, we'll probably be off to the races. But from what I could see, it looks like the euro's headed a lot lower.
Okay. Moving on to some specific stocks that you're looking at today, potential setups both on the long and short side. When I was just talking before we got on the air, you mentioned BlackBerry here, and just could you walk us through your thoughts on this stock?
This is a stock that I came into the year as one of my favorite names. I figured it would double pretty quickly. We got that. When we broke below the 2012 lows and then quickly recovered, and we got that false breakdown. To me, that's the most beautiful thing ever. I mean, that was in December when you make a new low. Everybody hates it. We know BlackBerry's in trouble. I mean, talk about the fundamentals of a company, right? This is another reason why I ignore all that garbage. I mean, think about it. You compare BlackBerry to Apple. BlackBerry lost $4 billion last quarter. Apple made $12 billion last quarter. Apple's flat for the year. BlackBerry's up 60%. So one has nothing to do with the other, in my opinion. I think it's more important to analyze the behavior of the market. You saw an epic short squeeze from BlackBerry off of the lows. We doubled. I think we double again. From a tactical perspective, you could use $9 as a stop. We break below that, then things probably start getting a little bit more messy. We probably have a little bit more consolidation taking place, but I definitely think that
double?
we're probably
You
heading
think
up
this
to 18.
really? You think this thing's going to $18, and that's just regardless of the thesis, your overall thesis on the market? You just think people are going to pile into this dog?
Well, BlackBerry has nothing to do with the market. So BlackBerry is its own animal. In fact, I mean, if you really want to get into it, it actually has a negative correlation to S&P.
Okay.
It has a negative 0.75 correlation over the last year. So to your point, yes, I like it, especially because I think the market goes lower.
What's your time frame on that for the $18 level?
Now, right now, this is happening. I mean, we got an epic short squeeze.
Okay.
Stock doubled. And we've consolidated now for how long? We've been consolidating for 2 months. Yeah, I think that's enough time. Yeah. I think we're off to the races, 100%.
So you're leaning on the $9 level there. Okay.
That's been support for the last couple of months.
I mean, you don't have
to break that. I mean, we got to respect that level.
Yep. I mean, you don't have to be, Bill O'Neill to, pick that out as a $9 is a great support level. So,
Yeah.
okay. And also, you got a retracement from, off the $11 level. You went down to 9. I mean, this could easily be at $10 in a couple days. So, okay. Is there anything else that you like on the long side?
The USD CAD, in other words, shorting Canadian dollars. I mean, this has just been one of my favorite names for months and months and months. And me, I love big round bottoms, big bases, and breakouts out of those bases. And that's exactly what we got in the USD CAD. I mean, look at a weekly chart of this thing. Just a big, huge, round bottom, beautiful
Is
base. I
there an
mean,
ETF? Is there there because I'm looking at my future symbols here and I'm a little bit
FXC.
okay. Yeah, give me a second.
Frank X-Ray Charlie. I mean, look at this thing crashing. It looks like emerging markets. Actually, it looks exactly like emerging markets. Isn't that beautiful? Yeah, I mean, it looks exactly like emerging markets, but worse, if that's even possible. So I love it. I mean, I think it's beautiful. We got a nice breakout. We got a nice consolidation, a nice, beautiful, symmetrical triangle. We got a breakout over the last couple of days. I mean, I think this has 116 written all over it. I've been saying that since the beginning, and everything that I've been seeing just continues to confirm that. It looks like we're headed higher.
Okay, any stocks that you're turning a little bearish on?
The regional banks. It, I keep fighting it, and I would say half the time we probably get stopped out. The other half the time we probably do well. It's just something that really, really bothers me. Financials have been underperformers since last July. I mean, on a relative basis, when you see financials peaking, I mean, July was how long ago? We're going on like 10 months ago that financials have been underperforming. So that's number one. Number two, we had a nice reversal yesterday. A lot of people got excited about this bank breakout. Then we rolled over, went out near lows. Pre-market, how are we looking pre-market? Not really much action pre-market, not really much going on there. But, if you want to get aggressive, what other thing that I don't like? I don't like that momentum on the sell-off in January. We hit some
That's
oversold
financials.
conditions. Oversold conditions are a bear market characteristic. When stocks are in bull trends, they don't get oversold. They stay in overbought conditions and remain out of those oversold readings. And we got oversold readings. We had a nice fade yesterday after the initial rally. From a tactical perspective, you could use yesterday's highs as your stop and really short the hell out of this thing, I think, KRE.
KRE is what you're looking at. Okay.
Yeah, the regional banks.
Yeah.
Yeah, you could probably fade these aggressively because from a risk reward perspective, I mean, what's the risk? I mean, you have very, very little risk, and if you're right, it's going to be a home run. I mean, think about it. You can make 10% on this very, very quickly, and really, what's your risk? You're looking at what was the highs yesterday? A little over 42.
Right.
You got 40 cents of risk, and maybe 10-15% to the downside at least.
All right.
And you have momentum rolling over on weekly time frames. Scary up here.
What we were talked a little bit earlier about the social media stocks, and Twitter just seems to be dead money here. Yeah, you trading that at all? You gonna try and buy it at the $50 level, or is the run over and you're just leaving this dog alone?
Yeah, I mean, full disclosure, we have some for investors, pre-IPO that becomes liquid in May. So I do have,
May.
I
That's
do have
interesting.
exposure through there. Tactically, would I be entering right here? I really don't see, an entry point. I mean, if you really want to push it, I suppose, you could use this $50 level as support and kind of stay long above that, just because it's proven to be support in the past. So if you really want to push it, go for it. Me, I'm more inclined to maybe trade off of a key reversal day, right? So if we see something like what we saw in regional banks yesterday where they rallied initially and then faded, and that gives us a nice entry and a nice risk reward, and we know we're wrong if we make new highs. If we could see something like that in Twitter, I would feel much more comfortable, from a tactical perspective for sure.
Yeah, we were talking about that too. Maybe a washout through that $50 level, maybe taking down 49.30, 49.40, and then come back up to that level. Just a quick question. You said you had some of the stock from the pre-IPO on that. I mean, is that totally restricted stock? I mean, can you sell calls against it at all, or did
No.
you try? You can't do
No,
any.
it's
You can't buy puts.
It's in a limited partnership.
Oh, so you can't even buy puts about it, huh? Okay, all right.
I mean, we can we do anything we want in the market. One has nothing to do with the other.
Okay.
Yeah, we could buy calls, we could buy stock, we could buy options, we could do anything we want. Yeah, one has nothing to do with the other.
Okay. And the biotech. I mean, that's had a great run. Are there any stocks in that sector that you like to follow?
It's another scary one. I don't like it. On the new highs that we saw in February, momentum started rolling over. We had a reversal. I was out on the stream on StockTwits and Twitter 2 weeks ago, pretty much near the highs saying, all you guys, you biotech guys, and I have a lot of friends that have been making a killing in this. So, I'm not just hating. I just think at this point, I'm not a hater. I mean, I want everybody to make money. I just know that's impossible. I think that, things have gotten stretched, very, very stretched, and I'm seeing momentum rolling over on multiple time frames. To be initiating positions here, when you're at historic levels relative to longer term moving average, I mean, you're at some historic extremes. So to be initiating positions in biotech here, to me, from a risk reward standpoint, doesn't make any sense at all. Especially because I'm bearish equities. I would absolutely not be chasing these guys. I would be fading it too.
Right.
Especially if biotechs, if XBI, for example, starts breaking 156, I think you could probably get another 35 points to the downside, something like that.
Okay, if anybody in the chat room has any questions on any individual issues or a take on the different sector, please join the discussion. We'd love to get your questions out to JC. Just to finish up here with a couple momentum stocks here, I see that well-defined support in the biotech. For you biotech traders out there, surely keep an eye on, you had multiple lows in that area. And that stuff is also so headline-driven, too, with all the drug trials and everything. But that well-defined support level, we'll just close out.
But that's why I stay with the ETF, because it's not headline-driven.
Exactly.
Because if you're going to be buying the individual
Good
biotechs
point.
and you could wake up at 5 in the morning, 6 in the morning, and somebody died in a trial or something like that, or God forbid something bad happens, and things cut in half and you're down 50% overnight and there's nothing you could do about it. So for the most part, especially as a technician, I try to stay away from the individual biotech names for that reason alone. But the XBI isn't driven by headlines because it's very diversified. So I'd rather be in something like that for that specific reason.
Okay, how about the Momos here? How about Tesla? It had the big run up after earnings here, and now it's just holding the 230 level. What just not enough bounce for you here? You think it's come down and fill that gap?
It probably will. I don't know. If you have to be long, which me personally, I'm not going to be initiating a position right here. But if you have to be long, I would stay long above these recent lows. What is it, like 228, something like that? You could probably use that as support. That breaks, you're probably going to see $200. I mean, if you really want to get down to details. For me, the upside potential based on the risk to me isn't worth it. But I think it's important to recognize that we all have different time frames. We all have different risk parameters. We all have different objectives when it comes to the marketplace. And this particular risk-reward setup doesn't meet my parameters. It doesn't necessarily mean that somebody else won't look at this chart and say, oh, wow, that stop at 228, with that risk, that's perfect for me, so go for it. But for me, it doesn't make sense.
Okay, NQ Mobile, headline stock. I believe Muddy Waters really beat up on this thing. They took it down. It's battled all the way back. It's an ADR. A lot of headlines battled back. Are you what's your interpretation here? It's battled almost all the way back from the Muddy Waters report and stuff. Slow rally back. You got any take on this one?
It looks like a mess to me. It really is. Like where are you wrong, right? So let's say I buy it right here at $20.31. Is it doing anything pre-market? It is not. So where are you wrong? Where are you wrong? You're going to take it all the way down to the 50-day moving average, and now that gives you 13% of risk. That's way too much for me. So if you enter right here, where's your stop? So that's the first thing that I have to ask myself, and I can't define that. I can't answer that question. So if I can't answer that question, and the kind of the weak answer that I can give is way too much risk for me, I wouldn't buy this thing. And what's the upside? Like, where am I going to be selling it? So anytime I look at a name, right, you ask me about NQ or Tesla, it doesn't even matter what the asset class is. Those are the first two questions I ask. How much risk is in there? and how much reward. And in this case, it just looks like a hot mess. I don't know the risk, and I don't know how
Okay.
much reward there is. So not for me.
Okay. And then also the KRE that you trade. Do you just trade that outright? Are the options? Is there any liquidity in the options, or do you just not interested in the options market?
Again, I am. I am very much interested in the options market, but it really all depends on what your time frames are and what your goals are. So for someone like myself, I would prefer to trade the equities in this particular case. Somebody else might say, no way, the puts are so cheap or whatever it is. That might be best for them. So in terms of what vehicle to use to play this particular asset, it really depends on you and how much risk are you willing to take. What's your time frame? I mean, me personally, I'm trying to make money right now. So if you're buying out of the money calls from several months out or whatever it is, you're doing that because that is what your goal is in the marketplace. So I can't tell someone how to play a certain situation. I could just say, this is where I'm wrong, and this is our target. I mean, that's really all I
Very,
can do.
very consistent, JC. I appreciate the way you look at these charts and automatically identify the risk and the reward. That's what we try and emphasize on the show. Thank you for everybody out there listening to the pre-market prep show. We are live with JC Parets, and we'd love you to join the discussion and get in here. Enter our live chat, run underneath the show. We need people signing up because DJ comes up with good questions, Violin Maker, SFG Bright TG. You guys are great. We'd like everyone to join the chat and throw some questions our way. All right, JC, we're getting close to the open. We're going to let you fly here. Thank you so much for coming on, and we'd really like to have you back any time that you're available.
Yeah, you got it. Thanks for having me. Always a pleasure.
Okay.
Have a good one, guys.
All right.